117,000 live from New York City this morning. Good morning, good morning. A blowout jobs report. Equities lower by more than 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, a monster month of payrolls gains, just as investors look for the chair to hit pause, and weak tech results colliding with a monster rally. We begin with the big issue. It's Jobs Day in America.
I mean, nothing beats the payroll reports.
Look at the labor market.
520,000.
We're still looking at an incredibly tight labor market.
The onus is on the economic bears.
In terms of actually showing some of these cracks.
Getting that last little bit of inflation wrung out is going to be the hardest.
Part of it is wages, and we're going to keep a very, very close eye on that.
Last month was 223, which was a bit lower than the month before, which was a bit lower than the month before that.
But I also think we need to keep a close eye on the services data.
There is altitude to lose before I think the Fed gets really worried about the state of the jobs market.
The risks in the US is that the labor market does stay a bit stronger.
We're seeing the Fed trying to keep its optionality open.
All they can do at this point is just sort of extend out the 25s.
Joining us now to discuss, Mohammed Al-Aaron of Bloomberg Opinion and Queen's College, Cambridge, alongside BlackRock's Rick Reeder. Gents, to the both of you, thank you for being with us. Mohammed, I've just got to say, wow. You've had 31 minutes to go over this one. Your reaction?
It's a three-part reaction. One, wow, stunning, awesome, great for the economy. Two, there's a bit of a puzzle. And three, there's a hope. So the stunning bit is the 517,000 job creation. You know, the top estimate was 300,000. This is way out of the league. And this is really, really good news for the economy. As is an unemployment rate down. We haven't seen this level for 4 decades. That's all great. The bit of the wage growth came in line at 0.3. But the hope, John, is significantly more people entered the labor force. You've heard me say over and over again, it's the supply side that can save us in terms of avoiding bad outcomes. And it's good to see the labor force expand, labor force participation going up, employment to population going up. That's all good news.
Rick Reeder, unemployment 3.4%, the lowest since May 1969. Your thoughts?
I mean, I think it's impressive. I mean, how many months are people talking about we're going to recession, deep recession? Listen, I mean, we're in pretty good shape here in terms of where employment is. And by the way, you think about the average hourly work week, what the work week ended up being. I mean, you talk about real income into the economy. I think it's impressive. You know, we think, went through the data over the last couple of weeks. There's still a dearth of people for the leisure, healthcare, education, accommodations, hotel, restaurant. We still think you're over 800,000 jobs shy of where you need to be on a trend level. So you're filling those jobs. And by the way, it's good for the economy because these are generally lower wage jobs. You're improving net disposable income for the lower wage cohort. So it's a good thing. I mean, obviously, does this pressure the Fed a bit? It does. But gosh, I actually think they should cheer this on to a large extent because inflation's coming down while this is happening.
We'll get to the Fed piece of it in just a moment. Equity futures right now down by 1.2% on the S&P 500. In the bond market, yields higher, as you might have guessed, up 12 basis points on a 2-year to 422, on a 10-year up 10 basis points to about 349. Mohammed, the PMIs, the ISM is still sub 50. And I wonder what you put more weight on, that or this labour market.
So, John, that's what makes it really, really difficult. You could have also said layoffs, okay, which are going to be reflected in the numbers, in the actual numbers that are measured down the road. It's really difficult. I tell you, I have not seen such an uncertain outlook for a very long time. The balance of risks is on both sides. So it is hard. And for the Fed, it is doubly hard. Because the last thing it wants to be seen is destroying the labor market to pursue an inflation objective. So this is a very complicated period right now.
No sign of it being destroyed right now, at least not right now, and not in that jobs report. Mike McKee joins us now for more. Hey, Mike.
Well, John, it is a shocking number, as you guys have been talking about. 517,000 jobs were created in the month of January. Way, way, way above what anybody expected. But even more interesting, perhaps, is the fact that the unemployment rate falls to 3.4%. You ask why jobless claims are not going up? That's probably why. The participation rate rises as well. And look at average hourly earnings. Despite all the good news, they fade a little bit. The December number moved up by 0.1% on a month-over-month basis. And so the drop to a 0.3 move brings us down to 4.4%. We are moving in the right direction, at least as far as the Fed thinks. Now, the jobs where they are and where they aren't, this is something I wanted to point out. We had a big drop in the total number of jobs created in the household survey, and on a non-seasonally adjusted basis, we lose jobs. The seasonally adjusted, we end up with 517,000. But some experts on this, including Omar Sharif at Inflation Insights, saying that the numbers look pretty clean, that that kind of seasonal adjustment is not unfair. So that may not be part of the issue. Where the jobs are, service industry jobs. Rick was just talking about the need for so many people in the service industries. 397,000 jobs, 79,000 in healthcare and leisure and hospitality. They're still short, but they picked up 128,000. Here's an interesting one, though, construction. I mean, this is January. This is when there's snow and floods and stuff all across the nation, and we're getting 25,000 jobs. So let's take another quick look before I go here at the average hourly earnings, because I want to point out that what we're looking at is a number that is coming down towards what the Fed thinks is sustainable. 3 to 3.5%, they believe, is the kind of wage increases you can get without pushing inflation higher. And it's heading in that direction. Now, John, I got one thing I have to add here. Sure. This was a mistake I made in the last show, so we'll call it a surveillance correction. Please do. There's nothing wrong with the open here, but I had said 886,000 additional people in the labor force. That's the total number of people that had been put in by the revision. The actual number in the labor force fell by 5,000.
I've got skin in both shows, Mike. Yeah. Don't worry about it.
Well, you weren't there, so that's
count
on me, not you.
Mike McKee, thank you, buddy. As always, Rick Reeder, the Fed chair, Jay Powell. If he had this labour market report with him on Wednesday, would that news conference have been much different?
So that's a good question. Listen, I mean, it's a pretty robust number. Do you have to put another hike, another 25 onto what the Fed does from here? Potentially. But, you know, I go back to if inflation, and by the way, you can predict. I mean, we still think when you look at where inflation is going to get to over by the mid-year, we think you're going to get headline PCE down to 2.9, core is going to get down close to 3. By the end of the year, you're going to keep decelerating. You look at used cars, you look at some of the commodity prices. So we think inflation is coming down. And again, I don't think that the Fed, if you have a dynamic where you're not getting accelerating inflation, some of those exogenous shocks, supply chains coming down. Listen, I think we're still getting close to the Fed pausing. Do we have to go another 25 after this report? Maybe. But I think the key is rate volatility relative to where we've been is coming down, which I think is a really big deal.
Mohammed, I'll come to you on a similar theme. Is the chairman of this Federal Reserve on the brink of pulling back maybe a little bit prematurely?
We'll see. You know, John, my view, and I put it in a Bloomberg opinion article, is they should have done 50 and then stopped. And why? Because this is a really good time to get the rate hikes out of the way. It seems that I'm less optimistic than Rick is about inflation. And that's because of what he said about services and what Mike said about services. Services are booming. So we're getting the goods disinflation, which is going to stop at some stage. You know, prices can't go down forever. That's going to stop. We have services inflation where the balance of risk is on the upside, and these are less sensitive to the interest rate tool. So when I look at that, I worry a little bit that we may be too optimistic about the path for future inflation, and therefore I would have corrected the understanding of the market of the comments of what was said at the press conference. I wouldn't have let the market run away as fast and as far as it did.
Well, Mohammed, let's pick up on that, because you used that word booming. This market, until this morning, has been booming year to date. The S&P 500 up around 9% year to date, the Nasdaq up by 17%. The chairman was asked about financial conditions. It was the penultimate question in the news conference, and I think a lot of people came out the other side scratching their heads. Let's go back over it. Take a listen to what the Fed chair had to say on Wednesday about financial conditions.
Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. There's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast.
Mohammed, I'm not going to try and persuade people to have a different forecast. Financial conditions haven't changed that much. How did you respond to that?
So I think what he was referring to is what Lael Brainerd referred to, which is a very narrow set of financial condition indicators. Mortgages, okay, things that very, very narrow set. And if defined by that very narrow set, then he is correct in what he said. However, that's not how monetary policy works. Monetary policy works through a much broader set of financial indicators. That's why the Bloomberg index, the Goldman Sachs index is much more holistic. And on those measures, we are as loose as we were last February. So, it may be that they're looking at slim down. Now, slim down has become the practice at the Fed, just like inflation now is core services, excluding housing, right?
Yep.
So it seems that we are in slim down mode when looking at certain data, which is understandable, but it's correct for the inflation data. I don't think it's correct for the financial conditions data.
Well, this starts to introduce the market question. Rick, was that a green light for you to buy risk?
So first of all, by the way, I have to go back to what Mohammed said because I couldn't agree more on one thing. So the Fed should go 50 and get out of the way and let the system do what it's going to do. I just want to reemphasize one thing. The service sector jobs are lower income jobs. You're keeping net disposable income higher. That cohort, rent, energy, food, is what burdens at it. As long as income stays high, it took 20 years to get inflation to 2%. If we run a little higher, and by the way, I think we're going to set a little higher in inflation than we have certainly over the last 10 or 20 years. But if that's the case, and we're closing the income gap and removing money from capital to labor, there's a lot of good stuff going on. So anyway, I just wanted to hit it because I think it's so critical. Anyway, back to your question. Listen, I think rate volatility is coming down. I think the Fed, I wish they did the 50 like Mohammed said, but let's say they do 25 and another 25. We're not doing 475s. We said this on the show last month. Quality income, you still can lock in yields now. In the equity market, our multiples okay. The earnings season was just okay. Tech wasn't. Gosh, if you can buy quality income and lock in, if you take some spread product and you get a 6 in quality income with rate volatility coming down, that's a pretty attractive environment. So, I think this is one of those environments. The economy is slowing. I don't mean to say the economy is reaccelerating. The economy is slowing, but at a pretty good level. I like buying income and holding it. And over the next couple of years, rates will come down. And I like locking in some of these yields today. And again, we're going to get some opportunity here. We certainly heard from the ECB. They've got a bit more to do. Although, like I said, I think we're getting close to where these central banks can, like Mohammed said, step back, watch the system recalibrate. I think that's a big deal.
Rick, you're not the only one on a fixed income call. You and I have gone back and forth on this. The fixed income breakfast buffet is not what it was at the start of the year. High yield spreads are now sub 390. Has the risk reward around that story, Rick, not changed at all for you?
It has a lot. Your point is very well taken. Some of these spread sectors today, the spreads are not that interesting. And so now do you think about, gosh, maybe I'll reduce a little bit of these high quality spreads and, high yield, I would argue we can get most of that yield, almost all that yield for some of the high quality asset classes, particularly in some of the securitized markets today. So that's not that interesting. One of the things that I think is Europe now, because of cross currency basis and otherwise, getting some yield in Europe in some of the investment grade products, actually European high yield is still pretty reasonable. And actually emerging markets, where you have a more two-way dollar, taking some emerging market, the yields, particularly in local rates, the yields are pretty attractive. But yes, you are right. These spreads in some of the areas we talked about a month ago, agency mortgages, investment grade, are not nearly as exciting. So taking changing your risk paradigm a little bit, but still keeping yield in, I think makes some sense.
Mohammed, you wrote about this morning. We've had this rip-roaring rally. You get this fear of missing out. The price changes, so the narrative does too, so more people start buying. We've just had a stellar run of gains year to date, and we're only a month and a week into this. You wrote this morning, when markets are this hot, should you jump in? Mohammed, should you jump in?
So I looked at the arguments on both sides and concluded very much consistent with what Rick just said. If you're going to jump in much more selectively. At the beginning of the year, it was incredibly attractive, particularly fixed income, incredibly attractive. But we've come a long way. And now, as Rick correctly said, it's about greater selectivity. There are still opportunities out there, but they're not as generalized as they were a few weeks ago.
Given how robust the economy is, how resilient the labour market is, I'm going to keep that in mind when I read you out this quote from Mislav Matejka over at JP Morgan. He said, Q1, in our view, will likely mark a turning point as the fundamental confirmation for the next leg higher might not come. And instead, markets could encounter an air pocket of weaker earnings and activity as they move through Q2 and Q3. Rick, Q2, Q3 feels like a lifetime away. Now, I know you don't believe in the hard landing story. You're in the camp soft landing, have been for a while. But let's assume you are in the camp that it's a hard landing. And I call you up, Rick, and I say, look, I'm really worried about Q2, Q3. I think we're going to hit that air pocket. What do I do between now and then? Is there a window here for me to put money to work? What do you say back to those people?
So, I mean, well, first of all, I think January was one of the most extraordinary months I've seen in my career. The short covering rally in places that had been beaten down a month prior was pretty extraordinary. And by the way, I saw a stat that was the most incredible I've ever seen. The companies that missed outperformed on a price basis than the ones that actually beat earnings. This was a crazy, crazy month in terms of what performed versus what didn't. I think today, the stuff that hasn't performed, where you actually have quality income, persistence. I mean, look at healthcare, how much it underperformed. Parts of healthcare are not going to see the same sort of growth, but there are parts where you're actually generating really nice income. So would I take some of those income producing assets, some of the, we call it the quality income today that have lagged in this surge to buy the short covering stuff that's rallied? I would do that. But listen, I think margin, part of why I think equities are just okay, is the margin compression is real. I don't think you're going to see a cataclysmic earnings dynamic, but in an economy that's okay, I think top line revenue is sort of meanders around, but I think you get margin compression. And so, part of why I'd rather buy income, both debt and equity, I'd rather buy stable income much more so.
Mohammed, it is the ultimate pain trade for anyone who tried to short this market, to see it rip the way it has. And for some people who have missed out on these gains year to date, I want to go back to the phone call analogy. Mohammed, for the people that sat this out, who want you to get back in, have you ever experienced that in your career, Mohammed? I'm sure you have on several occasions over the decades. How do you respond to that when the market starts to move the way it is and more people start to get on board? The fear of missing out takes over. I know where we are this morning. Put that to one side. I want to talk about the year-to-date move. Mohammed, what do you say?
Oh, the inclination is for you to get sucked in. Look, there's nothing worse than underperforming a rising market, especially after you've had a tough year where the returns were negative. Your clients say, come on. I lost money last year. I had an opportunity to recoup some of it, and you weren't fully invested. So the people who are not fully invested, let alone the people who are short this market, it has been incredibly painful. And I suspect a lot of people have given up. It started with the short covering that Rick talked about, but it's gone beyond that. Look, it's really confusing. I remember 2 months ago, you reporting on the consensus on Wall Street. And do you remember we were going to have a tough first part of the year and a good second part of the year? That was the consensus. Now it's turned upside down. We're going to have a good first part of the year, but it's going to get tougher in the second part of the year. And it just shows you that when you look at the three main macro drivers, growth, inflation, and policy, you can tell two-handed story for every single one of them, which means that the permutations that come out of that are very large. And that's where we are, John. And this is a really uncertain market. That's why at the end of the day, it's about if you end up being forced to make a mistake. No one wants to make a mistake. Which mistake can you live with? And that's not just a personal risk assessment is also a business assessment.
Hey, Mohammed, stay close. Equity futures right now down by 1.3%. We're about 11 minutes away from the opening bow. Just a stellar month of gains for this market and for the jobs market too. Yields are higher by 14 or 15 basis points on a 2-year. 425. AMH down in DC joining us for a conversation. Anne-Marie, I imagine that State of the Union gets edited just a little bit on the labour market.
Oh, it certainly does, Jonathan. How can anyone say that we're even close to a recession when you have 517,000 individuals being employed in the month of January? And on top of that, an unemployment rate we have not seen since 1969. So expect the president to come out today, declare some victory on the economic front. On top of that, Jonathan, later today, he will be in Philadelphia alongside Vice President Kamala Harris. Rare that you see these two individuals going out together outside of Washington, D.C., a joint event to talk about the economy. But obviously, this all points to a potential joint ticket once again for 2024.
On the same day you hear from the president in the State of the Union, February 7th, Fed Chair Jay Powell speaks in Washington at the Economic Club of Washington. AMH down in DC, thank you. Mohammed, I want to come to you on that. Are you expecting anything different from the Fed chairman next week than what you heard this week on Wednesday?
Really tough question, John. Really tough. And February 7th is going to be fascinating. I suspect he'd rather send other people to correct the market misunderstanding, if there is one, than himself. But it's going to be a really tricky appearance.
I want to come to you on this, Rick, in the bond market with yields higher by 14 basis points on a 2-year, on a 10-year by 12 basis points. Are we seeing some incoming information that challenges the bullish story for bonds, or is this an opportunity to pick up an extra 15 basis points of yield this morning?
Listen, I think this year is going to be about adding to yield into your portfolio. And I think, when you get opportunities, I think you're supposed to take advantage of. There's a couple of critical things. By the way, I don't think we're going to see a significant rate rally. I think people have gotten on board. Rates are coming down. The front end's pricing easing. I think that's aggressive. I think that the ability to carry and create this income makes for what will be a good year in fixed income. But, John, I think there's one really critical thing here that you used to ask me all last year, how much cash do you have? How much cash do you have?
Yeah.
The reason why you run so much cash is because you can't hedge it. You can't use interest rates. You can't use equity volatility because volatility is too high. You can't use the dollar when it's a one-way. It doesn't move around. Now you have hedges. That's a really big deal. You can build income in your portfolio. If the economy slows, you'll see interest rates come down now for the first time. If you have a dynamic that equity volatility allows you to do put spreads, allows you to do some things in single name versus index. First time in a while you can hedge, means you can run less cash, have some income, and then build some hedges in. That's a completely different paradigm around managing risk and building portfolios than we were 6 months ago. The only thing you do 6 months ago is just sit on a lot of cash and hope that dulls the volatility of your portfolio.
So, Rick, let's make some news. I mean, you brought it up, not me. What's your cash position now relative to a couple of months ago?
It's much lower. It's much lower. I mean, we're building. We continue to build this quality income in the portfolio, like we talked about the last couple of months. I mean, I think these yields, particularly, you don't have to go out to the 30-year, but you can build income without taking a lot of credit risk, a lot of liquidity risk, a lot of beta risk, and you can build a 5.5 to 6 pretty readily and hedge it now. That's really interesting. So yes, we've run down the cash a lot, but I don't feel like we're hanging out there risk-wise because of the quality assets. The point you made earlier. Do you have to run a lot of high yield? Do you have to run a lot of loans? You have to run commercial real estate? Not really. You could build quality income and sleep at night.
Hey, Rick, can we get Mohammed on board to keep coming back every payrolls Friday?
I hope.
He skips every other month.
If you want me back, John, you have to pick up on Anne-Marie's comment. We haven't seen this unemployment rate since 1969. For Jets fans, that's a really consequential statement because that's when we last won the Super Bowl. So there's hope for us, and there's hope for the Mets that won that year as well. So this is a very hopeful jobs report.
Better times, Mohammed. Fantastic to have you with us. A good friend of this program, a good friend of mine alongside Rick Reader. Tremendous, the both of you. Just absolutely brilliant. 6 or 7 minutes away from the opening bell. Coming up, big misses in big tech. Wedbush's Dan Ives joins us on the disappointing results from Apple, Amazon and Alphabet Plus. Secretary Marty Walsh coming right up. Equities right here going into the opening bell about 25 minutes away and about 20 seconds. Equities down by 1.3% on the S&P. On the Nasdaq, we're down by 2 full percentage points. If we bring up the bond market, the moves we're seeing off the back of this payrolls report, absolutely phenomenal. Yields higher by 13 or 14 basis points on a 2-year to about 424, on a 10-year up 11 or 12 basis points to 351. Tremendous moves off the back of a blowout jobs report. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Ford to sell from earnings, highlighting the limited visibility into the automaker's supply base. That stock is down by 8%. Next up, RBC Capital downgrading Boeing to sector perform, warning that supply challenges will likely cap any upside to deliveries. That stock is negative 1 full percentage point. And finally, HSBC downgrading Meta to reduce $110 price target, expecting competitive and macro headwinds to weigh on future revenue. That stock is negative by about 2.8%. Just to round things out for you quickly, the moves we've had off the back of this payrolls report, tremendous. The number, if you're just tuning in, I don't know where you've been, the number 517,000 off the back of that. Equities lower by 1.4% on the S&P. Yields higher by 13 basis points on a 2-year to about 424. Coming up, big misses in big tech. Wedbush's Dan Ives joins us on the disappointing results from Apple, Amazon and Alphabet, plus Labour Secretary Marty Walsh on a blowout jobs report just moments away. Let's get to that opening bell and finish up this week. What a move we've seen through the week. Big week of gains on course for that. Set to take a big bite out of it at the open. About 15 seconds away, we're down 2% on the Nasdaq 100. On the S&P 500, down about 1.2%. Taking a slice out of this market off the back of a monster upside surprise on payrolls. That's the opening bell. Switch at the board and get to the bond market. Yields higher on a 10-year by 12 basis points. Your yield 351.17. The dollar stronger. Euro dollar a break of 109, 108.50. We're negative 0.6%, and crude positive, just about, by 0.2%, $76 a barrel. We're about 15 seconds into this one, following a major upside surprise in a payrolls report. 500,000 to be precise on a payrolls report, 517,000 jobs added to the American economy. Equities down by a little more than 1% on the S&P. On the Nasdaq, down by about 2%. One sector to watch at the open is big tech. Apple, Amazon, Alphabet reporting weaker than estimated results and derailing the Nasdaq's run at a bull market. Wedbush making the case for buying the dip in Apple, writing the following: Cupertino is a Rock of Gibraltar tech story in a stormy macro environment. We would be buyers of this unique tech stalwart on China demand tailwinds and the gross margin expansion story. Dan, I'm pleased to say, joins us right now. So, Dan, for most people, that was a downside surprise. Why wasn't it that for you?
Yeah, I mean, because ultimately this quarter was all about the China shortages from the lockdown. 8 to 10 million iPhones. So I viewed the miss as sort of, ultimately really saw through it, because to me, it's all about what the guidance and comments are going forward. This is an accelerating China story into the next few quarters. That's what Cook talked about. And even though revenues is coming down, gross margins, it's a 10-year high. And I think that just shows the power here that they're going to ultimately see. It's a demand that continues to be firm. Supply was really the issue in the December quarter.
Dan, I just want to work through the price action briefly, about 90 seconds into the session. When you look at these numbers, bear in mind these names had a massive move high yesterday. Apple's down about 0.8, Alphabet's down 4%, Amazon's down by 5.8%. Dan, would you define Q1 then as a clean quarter to judge Apple by? Can we put you down on that one? This one's going to be a clean quarter and we can judge this stock. And if China comes through soft, there's something worse going on here.
Yeah, I mean, look, market, because I think 3 months from now, if that story ultimately takes hold, this is, a stock that's going on its way to $200. I mean, that's our view on the sum of the parts, because it also, you go into this earnings season, Armageddon expectations across tech, not falling off a cliff, modest softness. That's the narrative that really came across. And I think everyone was sort of underweight. I think it's as underweight as I've seen tech since 2009. That's what we're buyers here. I view it as a green light.
Well, that's a positioning story. Let's talk about the fundamentals. Deceleration deceleration in AWS, deceleration in the cloud business elsewhere over at Microsoft. Dan, surely when you go from acceleration to deceleration, that's a shift, and these companies might have to be valued differently. How are you changing?
Yeah, and look, and I think ultimately the valuations were really reflecting massive decels. Instead, you've seen modest decels. And I think going into the next 12 to 18 months, then you start to see an acceleration back into what I view as a more normalized environment. You've seen the cost cutting. You got the Band-Aid ripped off. Ultimately, numbers are now hittable to beatable. And I think now it's set up where, you know, we thought going into this year, tech stocks would be up 20%. You talked about it.
You got it in a month.
You know, I ultimately believe no, but look, I believe now we sit here end of the year, tech stocks are up 30%.
30%. There is a danger here, Dan, that all of this was just short covering. You mentioned the positioning story and that we're redefining the narrative based on the price action over the last month or so. As I say, deceleration in the cloud business elsewhere. What is in the fundamentals that you see that makes you think that we get a re-acceleration in those themes when the companies are telling me completely the opposite?
Well, look, I view it, we're in the early stages of a fourth industrial revolution. From AI, that's why Microsoft paid $10 billion for ChatGPT. You look at what we're seeing in the cloud, only less than half the workloads are on the cloud. And I think we're now going into the next phase of technology trend. And even though we're seeing a slowdown in the macro, I think ultimately the cost cutting, that leads to the next cycle. And that's sort of our view for high quality tech. Profitless tech, some of that, they'll fall by the wayside. But also I think there's going to be a lot of M&A, a lot of activism. And right now, New York City cab drivers bearish on tech stocks.
Well, Dan Ives, I don't think that's the case anymore because we've had a massive run year to date. Dan Ives of Wedbush, sticking with the bullish call. It's working so far this year. Let's see if this changes. Do we actually get that re-acceleration Dan's looking for? Because the companies aren't looking for that. The equity market down about 1% on the S&P 500. We are about 4 minutes and 40 seconds into this session. On the Nasdaq, we're down about 1.8%. Just a fantastic jobs report. To see the jobs number come in at 517,000 and unemployment drop to 3.4%. That is truly, absolutely phenomenal. On Bloomberg TV and radio, I'm pleased to say that US Labour Secretary Marty Walsh joins us now from Washington. Now, Marty, did you have to edit your notes once you saw that jobs number in the last 24 hours?
Well, I looked at my economist and I said, you were way off today. You know, it was, you know, and I was on a call with some folks from the White House earlier, and they said, what do you think about the jobs report? I said, it was a good, steady jobs report. And Jared Bernstein made a joke. He said, you never change your tone. You know, it was a great report. I mean, when you look at areas that I think are really important, business grew, healthcare grew, education grew. And we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs for the economy and concerns about the economy. But right now, certainly I'll take this jobs report for any day of the week.
Well, Secretary Walsh, I've said it to you now 2 months running. I mean, you've been right. I've tried to push back, but ultimately we're seeing this jobs growth without that inflationary impulse, without wages picking up. We're seeing participation start to climb. Secretary Walsh, what are the dynamics underpinning that, do you think? Why do you think that can continue?
I mean, I think we're still going to be assessing that and evaluating that for years to come. I think what's happening at this moment in time is something that economists and folks like you and me and all of us will be talking about down the road. I don't think there's really an answer other than, you know, the president did lay out an agenda in 2020 to get people back to work. And then in 2021, he laid out an agenda to tackle inflation. Obviously, the Fed is doing their thing as well. And I think we're living in a very different time right now, economic times. And, you know, most economists or people who are business people won't really might not agree with what I'm about to say, but I just think that these are times we've never really experienced in this country, and we just literally have to take this month to month to see as long as we can move forward and avoid a recession and avoid a downturn in the economy and try and create as many opportunities both for employers and employees in this country.
Well, the data is speaking to that right now, and the president has some fresh numbers to put into that State of the Union address next week. Secretary Walsh, I know you've got to run, so I want to work through a couple of issues with you. Here's one. You usually give us an update on what's happening on the West Coast with the dock workers contract. Where are we now? Have they asked for your involvement at all?
No, I mean, I've been in steady contact. This week I talked to all sides. They were able to work through some of the more tricky issues out there. They have not asked per se for me to come out and talk to them. I did go out January 2nd to sit down and talk to the companies and some of the union guys out there, union people out there. They're moving along. Certainly, as I said to you a long time ago, I wish this negotiation was done, but there's a lot of issues out there that they want to go through. But so far, hopefully we don't have anything that will hold this contract up, but certainly it's something I'd like to get done sooner rather than later.
You've been pretty calm about it, and I often ask you, when does the red light start to flash? Are we getting closer to that point for you?
No, it will flash to me if there's an issue that I think is going to be one of those make or break issues. You know, like in the railroads, when we talked about, you know, the negotiations weren't really going on as they're moving forward. When sick time came up, paid sick time came up, I kind of knew that was one of those red flashing problems. I haven't seen that yet in the ports negotiations, and I think that, you know, the way they work is a lot of the unions work and negotiate with individual ports, but there is a master contract. I don't know if that's the technical name for it, but right now I'm not concerned about that yet. I mean, listen, it could change on a dime, obviously, but right now I feel good.
Secretary Walsh, usually Tom Keene and I like to talk about football, real football, the stuff that happens outside of the United States. I'm told you're a massive Bruins fan. Is that true?
I like the Bruins, I like the Patriots, I like the Celtics, and I also like Man United.
Oh, you do as well. The reason I bring up the Bruins is because there's some interest in perhaps maybe you going to the NHL Players Association. Any truth to that, Secretary Walsh? There was a report from Politico this week.
I don't have any personal news to make today. Today I'm focused on a jobs report that has shown since the President Biden has taken office, 12.1 million people have either gone back to work or jobs been added to the economy. And you know, certainly, this is such an honor being Labor Secretary. And on a day like today, I feel even better about it being able to be on TV.
That sounds like you've got some news to make tomorrow.
I live my life a day at a time, so we'll see what happens.
Secretary Marty Walsh, I think we can read between the lines there. It's good to catch up, sir, as always. The Labour Secretary there, Marty Walsh. Coming up, more data coming in after today's very, very hot jobs number.
It could well be that, you know, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth.
That conversation still ahead. Plus, iCapital's Anastasia Amoroso, PGIM's Mike Collins joining us, and Mike McKee's going to run back to the studio too. That's next. This is Bloomberg.
It could well be that, you know, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. Given what we know about the trajectory going forward, you know, there's risk that employment will remain strong.
Neil Dutter of Renaissance Macro, 517,000 in the jobs report, 3.4% the unemployment rate. You've got to go back to May 1969, and the equity market down 0.7% and trying to stage a comeback. The Nasdaq down by 1.2% in the bond market. Yields much higher by 11 or 12 basis points to 422 on a 2-year. On a 10-year, up 10 basis points to 349. With us, I'm pleased to say, iCapital's Anastasia Amoroso, PGIM's Mike Collins. To the two of you, just a wow morning, Kay, with the market action of the year to date. And then this morning, off the back of a massive payrolls report. Anastasia, you said it, 3 silver linings. I imagine the data this morning backs that up.
Well, it certainly does. And John, I think I said it last time on Payrolls Friday that it was a soft landing type of a report. And this is yet again a soft landing type of a report because we're seeing phenomenal job creation. We're seeing job openings that are still at 11 million. And as a result, these layoffs are not resulting in higher unemployment numbers. So as long as consumers are gainfully employed, that's going to prop up the economy. And I guess the other silver lining is that the wage inflation, 4.4%, a little bit higher than expected in last month, year over year, but it's still sort of holding in this 4% range. So that's the silver lining, John. But I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started and it's soon going to start in the services part of the economy. I think it challenges that view because if you have 11 million jobs out there and people are going to find jobs, that still creates some wage pressure. And 4% year over year wage growth is just not good enough for the Fed. So near term, I completely understand the market reaction. And frankly, we've come up a lot in a short period of time. So I'm not surprised to see this give back.
Mike Collins, your reaction?
Yeah, undoubtedly a strong number. Obviously we take single data points with a grain of salt, Jonathan. But if you look at the, half a dozen or so last reports, the job growth is averaging, 350,000 or so a month. I mean, you cannot discount that. The sectors that we've seen the most growth in recently are the ones that, believe it or not, still have not gotten up to the level of total jobs since before the pandemic. Things like leisure and hospitality, healthcare, construction, services. We're still short jobs in those sectors. And as we all know, the services sector, the travel sector has legs to it, right? I mean, this COVID rebound has legs and it continues to boom. So this is a really good report for Main Street. This is a really good report for people. And you're seeing the movement in rates and stocks. They're still within the range of the last few days. So nothing dramatic. It's a good backdrop.
The president agrees with you. He said jobs are going up, inflation's going down. My economic plan is working. You'll hear from the president at 10:15 Eastern time, about 30 minutes from now. Mike, let's take the price action away. The market reaction to the payrolls report from an hour and 15 minutes ago. Let's park that, pretend it's not happening. When you look at that report this morning, does that raise the risk that this Fed needs to go further? Or do you take comfort from the fact that you can get unemployment drop into 3.4% without wages accelerating?
Yeah, I mean, we've already seen a deceleration in the wage growth, right? From the mid to high fives down into the kind of mid fours. And I think a lot of that is the mix shift, right? You're seeing all the anecdotal evidence of these kind of high paying white collar jobs being eliminated from the tech and financial sectors and being replaced with those lower paying services jobs, Jonathan. So that naturally brings down the overall level of wages, which is good for the disinflationary story. But that doesn't mean individuals won't still have, power, won't still have bargaining power to get higher wages. So if wage growth stays, in the threes or at 4%, and inflation only comes down to 2.5 or 3, I don't think that's a bad world. Yeah, that's a world where the funds rate has to stay above 2.5 or 3. So maybe the funds rate lands, at 4% for the next few years. That is not a bad world for investors.
We've had a year of gains for investors, a year of gains in a month. Anastasia, it's what now? What now?
Well, what now? I do think that at this very moment, we are due for some sort of pullback and consolidation because, if you asked me 2 or 3 weeks ago, I would have said, well, we're not yet at technically overstretched levels. And, maybe this market has more room to run, but we are approaching overbought levels certainly on tech and on other parts of the market. And the risk that I think these markets may need to appreciate is there's a risk that with the part of inflation that it has in fact been transitory is the goods inflation, the supply chain bottlenecks. It seems like it took longer to transition, but it seems like it is transitioning away. And that's why the headline inflation is falling as food, fuel, and durable goods prices are falling. But there is a risk that I don't think market participants are really focused on, that maybe there's a secular inflation narrative that is more sticky, and that is wages. If we do continue to see the strength in the labor market, wages don't go down to 2%, maybe they stay at 4%, that's a problem. And we may end up in a position where, especially as China reopens, and that puts pressure on, the goods sector inflation again, especially via energy. And then we still have this sticky services inflation, then maybe we're not, in fact, on the path to 2%. So that's the risk that I worry about, that the markets sort of need to price in near term. So the view is, yes, there are silver linings. Yes, there's reasons to be more constructive on stocks this year, but it's really difficult to see us go above 4,200 until we convincingly get rid of inflation.
Given what you just said about inflation and the backdrop and what may materialize later in the year, I'll get my words out. It's been a long morning. Anastasia, does that shape your view on what sector you want to be in? Would you fade the leadership in tech you've seen so far this year?
Well, again, it's all about the entry point into the sectors that we like, which I do like semiconductors, I like software, I like real estate. Now that they've run up, in the case of semiconductors, 15% or so year to date, I wouldn't tell you that now is the time to add to them right now. But as things pull back, the type of sectors you do want to buy are the ones that are well positioned for the Fed funds rate to peak and for inflation to sequentially come down. And that brings me to semis. I really like that space because valuations have been cut relative to last year. And semis are very highly correlated with manufacturing PMIs. Well, the PMI data went from 60 to now 46. So we've seen a bulk of the correction in manufacturing. And for that reason, I think we might have seen a bulk of the correction in semiconductors. And semis, by the way, have the sensitivity you want to falling inflation. So I think there's a lot supporting the sector, and especially the secular semis. It's not about memory, it's not about PCs and smartphones, but it's about artificial intelligence, for example. So that's where I would focus within the markets right now. But I would do so once the semi stocks correct just a little here.
Mike Collins, that's equities. Let's finish on credit. High yield spreads have tightened so much, 386 basis points now, Mike. I asked this question of Rick Reeder earlier on. When you started the year, it was buy fixed income. It looked great. There were big yields. Is the same true now?
Yeah, Jonathan, I think in high quality bonds, to Rick's point, we're kind of in agreement with him on this one. There's so much value in high quality interest rates, high quality spreads, but I don't think you're getting paid enough yet to go down in quality aggressively, right? Yeah, the high yield market's yielding, 8 and change, but you do lose some of that to defaults, and we know default rates are going to go up. These higher interest rates, as companies have to start refinancing their debt profiles, and consumers, right, and real estate investors, that is still going to bite. People talk about these lags of monetary policy, and I think the longer that funds rate stays around 5, it really does start to bite. So you're going to see more weakness later in the year. Yeah, maybe it's not the hard landing, and I've been in that kind of soft landing, mild recession camp all along, and it seems like that scenario is really playing out here. So it's not a disaster for high yield, but at these levels, it's not really attractive. But it's a year where you buy on the weakness. You kind of hope for spreads to widen, and you buy because now you have the Fed potentially behind you. To Rick's point again, last year you went from a year where the funds rate went from 0 to 5.
Yep.
That's a year where you kind of sell into rallies. This year, they have 500 basis points of capacity to support the economy if it does weaken. That's a really good position to be in.
Mike Collins, this was great, as always, alongside Anastasia Amoroso. To the both of you, thank you. Bit of news out of Washington. The Biden administration had been weighing whether to postpone or cancel an upcoming trip of Secretary Blinken to China, given the latest news over the last 24 hours that the US had been detecting a Chinese surveillance balloon over the United States. We're getting some news just now. The US to postpone Blinken's visit to China over that spy balloon. So that's the latest news there. One more piece of news. We always knew this. The president watches Bloomberg surveillance. Mike McKee saw that hit of yours at about 8:30 Eastern time, retweeted it and said jobs are going up, inflation is going down, and my economic plan is working.
Very flattered. I guess you can credit the president because the president has to take the blame when things go bad. So, a lot of this has to do with the spirit of the American people, but he can grow today. John, we did have a little economic news while you were talking to Mike and Anastasia. The S&P Global U.S. Services PMI comes in a little higher, 46.8. The composite comes in at 46.8. Those are up 2 ticks. The next thing is ISM, top of the hour.
Looking forward to it. Mike McKee, thank you. Your trading diary up next. 26 minutes in. Price action lower. Here's the trading diary. Coming up, ISM Services top of the hour. President Biden, 10:15 Eastern. Fed speak returns with President Mary Daly on deck, plus Fed Chair Jay Powell speaking next Tuesday, along with President Biden's State of the Union address. From New York City, what a morning. Have a wonderful weekend. This was the countdown to the open. This is Bloomberg.